somebody remind me to talk to Bill about under-promising and over-delivering. What did I do with that crystal ball? Thank you for the introduction and for the brevity, the appropriate brevity of it. I joined Brown Brothers Harriman literally 3 weeks after graduating from college, and I've been there ever since. So my resume fits on one side of a 3x5 index card, and I'm proud of that. I'm also proud for 25 of those 35 years, I have known Jeff Holler and worked with the Capital Chart Room on mutual client relationships. And I'm even prouder of the fact that at this 5th annual Fort Worth Business Owner Summit marks my 5th annual appearance. And I can only assume that I will continue to be invited back until I get it right. That's called job security, because to Bill's point, no one has a crystal ball. I don't have a crystal ball. I'm just trying to make sense of the context of things that are going on in the marketplace. When Angela reached out to me maybe 6 months ago to sort of hone in on the date for today's gathering, she asked me, what do you think it is that you want to talk about? And I said, something will come up. Something will come up, I'm sure. So here are the things that I'm going to talk about in this order. I'm going to talk about the elephant in the economy, tariffs, a little bit, briefly, because so much has been written and talked about that you've read a lot of it. What I'm far more interested in, the second thing, is the implications for economic activity, the ripple effects of the lack of predictability and the uncertainty. I think that's actually a bigger story for investors and for business owners and managers, and it hasn't gotten the oxygen that I think it should. Third, very closely related topic is how does the Federal Reserve respond to all of this? What does it mean for interest rates? That's obviously important for the cost of capital. If you're borrowing money, it's important if you're allocating capital into financial markets as well. And then fourth and finally, at the end of the day, I'm an investor. I invest money on behalf of clients at Brown Brothers Harriman, so I want to end by sharing with you what I'm telling our clients about how to allocate financial capital in this environment. Everyone in this room has 401ks or SEP IRAs or something like that. And I'm going to do all of that in the 3 or 4 hours, Cammie. How much do I have? 4? 30 minutes, she says. I'm going to do all of that in the time that we have left between now and lunch, and hopefully leave some time for questions at the end as well. I will put this slide back up at the end. That's my contact information. Capital Chart Room also has these slides. If you'd like a copy of them, I'm happy to send them to you, and Angela and the team can send them to you as well. Let me start by talking about the bull market we're in. Not necessarily the bull market in financial assets, but the bull market in uncertainty. Duh, you know that already. What's interesting is to see the level of that uncertainty and unpredictability. This is a study done, sort of a combination of AI, big data, looking for word associations in media, broadly defined to include print media and social media as well, for combinations of words like doubt, chaos, uncertainty, policy, et cetera, et cetera, et cetera. It's not a surprise that uncertainty is at a really high level. What's really interesting to me is you look at where we are now, uncertainty is actually a little bit higher than it was in March and April of 2020. That is hard for me to wrap my head around because there was no certainty about anything in the early stages of the pandemic, and yet here we are again. Proximate cause for that is obvious. It's the off again, on again tariffs. Have they been postponed? Will they come back? They've been postponed for 90 days. Does that mean on July 9th we're going to get them again? What I'm hearing from my clients, and particularly people like you who own and operate businesses, is a different level of unpredictability and uncertainty. It's just the math of how do I put these tariffs into place, because there are a lot of them. Prior to Liberation Day, there was already a pre-existing tariff regime, much of which put into place by the first Trump administration, interestingly left in place by the Biden administration. So there was a pre-existing condition, if you will, on top of which all of these different flavors were then layered, and I won't read them to you. And then, of course, the final one that I put in red there is, to what degree are some of these carved out? To what degree are they exempted? Just yesterday in the auto sector, it was made a little bit clear that some of these tariffs don't actually get added to each other. They replace each other. And so I hear a lot from businesses, I'm not even sure how to do the math for all of this. That's a level of uncertainty well beyond the headlines of, are they on again or are they off again? I'm an historian by trade, so I'm kind of required to show you a very long-term time frame chart. This is that chart. This is a history of tariffs in the United States of America going back to 1891. The average tariff rate applied to all imports, that's the light blue line, and the tariff rate applied to dutiable imports is the dark line. And again, this chart starts in 1891. And I show you this to observe that the White House is absolutely right that tariffs have always been a part of the American economy. The second act of office for George Washington was to impose tariffs on imports from Great Britain to protect a very, very young American economy. And indeed, prior to World War II, tariffs were the backdrop of what we did, because this is a little bit hard to contextualize as we sit here in 2025, but prior to World War II, we were an emerging economy. We were not the global manufacturing industrial leader. Germany was, Great Britain really was, with an empire behind them. So we needed that kind of protectionism. This peak there, by the way, is the Smoot-Hawley tariffs in the early 1930s. Just after World War II, and indeed because of World War II, tariffs ceased to be that big a part of the backdrop. They were still there. Tariffs have never gone away. Every president, going back to Washington, has used them in one way or another, regardless of political affiliation. But after World War II, the General Agreement on Tariffs and Trades was created in 1946. That's the precursor for the World Trade Organization. And perhaps more importantly, in 1947, the Marshall Plan, where the United States of America took its dollars and its structures and rebuilt Europe. The proposals that are on the table now, again, just to put them into an historical context, would bring the average rate of tariffs, that dark blue line, back up to that's about 22%. Again, if everything proposed becomes reality, if the postponements actually finally result in implementation, it would bring tariffs back up to a level not seen since prior to World War II, a very, very different environment. The single best analysis that I have read of tariffs and the potential impact of tariffs on an economy was sadly not written by me, and sadly not even written in the 21st century. The consequences, this analyst writes, of so great and so sudden a disturbance of our trade, which must affect our exports as well as our imports, are not to be calculated. An excessive rise in the price of foreign commodities or goods and a proportional decrease of price and demand for our own goods, the derangement of our revenue and our credit, these circumstances united may occasion the most dangerous dissatisfaction and disorders in the community and may drive the government to a disgraceful retreat, independent of foreign causes. Any guesses? The first Secretary of the Treasury, Alexander Hamilton, writing in 1794. The preacher in Ecclesiastes was right. There is nothing new under the sun. Trade, the challenges, the opportunities, double-edged sword, that it provides to this country are nothing new. We're just going through it again. But the words of Hamilton really, really do echo. And here is my own bias. I am a free trader. That does not mean zero tariffs. But free trade really is a tide that lifts all boats. Here's what I'm worried about. I am worried that the economic ripple effects of this may already be underway and may in some ways not be stoppable at this point. Think about just the time frame of the way things move. A ship, a dry cargo ship, leaves China. Depending on what the ultimate port is, Los Angeles, Houston, Newark, it's a 2 to 4 week, 20 to 40 day journey before it actually makes landfall here at a port in the United States of America. Then it gets put, intermodal transport, it gets put onto a train or maybe onto a truck, and depending on where it's going, that's another handful of days, maybe a week and a half before it shows up at the ultimate market. And then you begin to see, when those ships stop arriving, some of the supply chain disruptions that I think will feel eerily familiar to about 5 years ago. Totally different catalyst, obviously. But these supply chain disruptions, as this works its way through, the physical movement of goods, is something that I think will begin to feel a lot more real as we head into May and even into June. As an economist, what I'm watching very carefully is not only how this unfolds, but whether or not, or to what degree, it begins to affect things like inventories, things like jobs, things like retail sales, things like availability. This is not just a theoretical construct. It's already beginning to happen, and we can track that. We can track literally how many boats are leaving China. This is that measure. That peak and that decline is obviously right around the beginning of April. I mean, do the math, that's 28 days ago. So we're kind of right in the middle of that 20 to 40 day window. Just yesterday, the director of the port in Los Angeles, who obviously knows what ships are expecting to be coming in, is talking about a decline of something around 35% in arriving traffic. That's a 35% decline from peak to trough. Same graph if I look just at tonnage. Forget about number of ships, just like how much weight of stuff is on the water headed our way. And I'm using, just to be clear here, dry cargo tonnage, because what I want to back out of this equation is oil and energy, wet cargo, so to speak. What I'm really interested in is the goods that are really in the crosshairs of tariffs or the potential threat of tariffs. Another ripple effect of this is it's already obviously beginning to affect corporate sentiment. This is a very busy chart. It's basically all of the regional Federal Reserve's surveys on new order expectations. I updated this just a couple of days ago because it just got the final April data, and actually it was the Dallas Fed was the April data that came in last. Hard to see, but basically all these lines point down. The Dallas data, which is the light blue, is -20. That's not units of anything, it's just an index survey. But these are companies beginning to say, in light of this uncertainty, in light of this unpredictability, I'm not sure how I can talk about things like pricing or expansion or hiring or strategy, because uncertainty leads to paralysis. And you see this again and again in all kinds of different confidence surveys. This is the CEO confidence survey. Again, not units of anything, just measures. It's the directionality of that line that really carries the message that I'm focused on. Now, what I'm worried about, and I'm sure some of you in this room could tell me anecdotal stories of this, what I'm worried about is a slowdown in business investment and business activity and business spending translates into a slowdown in economic activity. That's important because business spending accounts for about 18% of total gross domestic product, 18% of GDP. That's important. It pales in importance, though, to the importance of consumer spending. Consumer spending is about 68% of GDP. And there's an analogous drop in confidence taking place on the consumer level as well. If companies are wrestling with pricing and hiring and spending and expanding product line, families are saying, can we really afford to buy a new car this year? Maybe the old car can last another year. Maybe we don't renovate the kitchen because I'm not sure what's going on. Maybe we don't take that vacation. When you aggregate that all up, you really do begin to get the recipe for a slowdown in economic activity. You can see the consumer confidence numbers, future expectations, again, back down to where they were during the pandemic, kind of an odd litmus to be back at. And as concerning, consumer sentiment related to employment. This is a measure that just asks people, do you think unemployment a year from now will be higher or lower? The last data point there is 65% of people think unemployment will be higher. That weighs on job security, that weighs on consumer confidence, that weighs on the ability to think about ways in which a consumer might spend money. This is all happening in kind of real time. I mean, think about what this presentation would have looked like if we were gathered for this summit on March 30th instead of April 30th. A lot's happened in the past 30 days. One of the challenges with economic data is, well, by definition, it's all backward looking. It has to be. It's like in the books, if you will. But it's also very lagged. So if I'm looking at economic data, in some economic data series, the most recent data point's February, totally uninteresting, ancient history, irrelevant. Even March data, that's a long time ago. April, a little bit better. So I've become quite fond of anecdotal information, or what I've come to think of as artisanal small batch data. I find myself very grateful for the TSA, which is not a sentence that anyone has probably ever uttered before. I go through them 6 or 7 times a week. But the TSA releases on a daily basis how many people walk through a TSA checkpoint. That's interesting. It's interesting because my most recent data point for that's 2 days ago. That's like a real pulse check on the economy. Now, I don't know if those people are traveling for pleasure, they're traveling for business, but I kind of don't care because there was a decision that was made to, I'm going to get on the plane and I'm actually going to go to that meeting, or I'm going to go to that conference, or I'm going to take that vacation. There's a little bit of a discretionary spend behind that. In 2024, TSA traffic was up almost 5%. That's the left-hand side of this page. But look at January, February, March, and the first basically 2/3, 3/4 of April. There's a distinctive trend there. It's not really conclusive of anything other than to say, on a year-over-year basis, the appetite for travel has begun to wane. I'm not sure how much of an economic hook that is to hang your hat on, but something is taking place there in terms of the willingness of both businesses and consumers to spend. The Atlanta Federal Reserve does a really interesting analysis that they call a real now GDP analysis. You may have seen it. I'd never seen it in the popular press until about a month ago, and it began showing up. And it's basically kind of a back-of-the-envelope calculation in which the Fed asks itself the question, if the economy were to grow for a full year at the pace it's growing at today, if we were to annualize today, what would that look like? This is not how GDP is calculated. That is not the right way to calculate GDP. So don't read too much into this. It's just a pulse check on the current pace of economic activity. This is that analysis. For reference, the dotted blue line on this page is fourth quarter GDP growth, fourth quarter of 2024, 2.3%. The red line is that series that I referred to, the pulse check. What if it were today? What if it were today? What if it were today? Well, the what if it were today number is negative 2.5%. I want to be very clear about what that does not mean. It does not mean that we're in a recession. It does not mean that second quarter GDP will be negative 2.5%. It does mean that something happened just as all of the conversations about tariff became reality that marked a substantial slowdown in economic activity. And to put in the category of artisanal, it's not even artisanal, it's a very real, fresh economic data. As we were sitting down for breakfast this morning, you may have seen this on your phone, the Bureau of Economic Analysis released the preliminary GDP numbers for the first quarter, and it had a negative sign in front of it. So GDP for the first quarter of this year was negative 0.3%. Let's call that a slight contraction. Now, the interesting part of any economic report is always in the detail, so I'm going to tell you why it was down 0.3%. Imports in the first quarter of this year, up 41% year over year. Now, imports are someone else's GDP, not ours. The D stands for domestic. So if we import something, it's someone else's GDP. It's China's GDP. Imports up 41%. Why? Why were imports up so much in the first quarter? You can tell me that better than I can tell you. Those are companies getting ahead of the uncertainty of tariffs and saying, I'm going to buy now while supplies last. I'm going to buy while I can confidently know what my prices are. I'm going to fill up the warehouse with what I may need because I'm not sure I'm going to be able to get it or at what price I'm going to be able to get it down the road. That will not recur in the second quarter of this year, or at least won't recur at that same pace. So even though there was a negative sign in front of that, I'm not standing in front of you saying we're in a recession or we're headed to one. I do worry the longer this uncertainty lasts, the higher the odds that we actually do head into a recession. But I think what we'll see in the second quarter, the quarter we're now in, we'll see a reversal of those imports because they just won't happen again. A lot of that was demand brought forward, and we'll see a positive GDP mark in the second quarter of the year. What I am way more interested in is the third quarter, because that then begins to become real. How much of this is actually embedded into the real economy? How much of it is just a fibrillation associated to the uncertainty around tariffs? Now, if you've been to these before, you will know that I try very, very hard when I'm standing here in front of a podium to not be political, even though much of what I talk about is policy-driven. But I'm going to do it for just one slide, because I think this is really interesting. It's also a little bit amusing, and it tells a story about the nation that we live in and the environment that we live in. All of these consumer sentiment surveys are done at very high levels. The people who do them, the best surveys done out of the University of Michigan. It's the best just because they've done it for so long. Their data sets are very deep, they're very broad, and they're very rich. They have a survey that asks consumer confidence by political affiliation. You ready for this one? This is the Consumer Sentiment Survey done by the University of Michigan for registered Democrats. A sharp, sharp decline in consumer confidence over the past few months. What do you think the Republican line looks like? It's really interesting to see how, with some regularity, confidence in the economy flips. It did it in 2016, it did it again in 2020, and it did it again in 2024. It's almost like something happens every 4 years that changes the lens with which people view the economy. I say this partially to be a little bit amusing, but partially also to observe that, yeah, the political lens really does influence the way people view economic activity. Interesting. I'm not sure whether that's good or bad, it just kind of is, but that is the world that we live in, and I think we would be well cautioned to just remember that other people see things in very different ways. Regardless of your political affiliation, this is the kind of environment in which the Federal Reserve, our central bank, ought to be thinking about lowering interest rates. Remember, the Fed has two jobs. Their job description also fits on a 3x5 index card. Two jobs, one of which is to pursue policies that foster economic activity, narrowly defined as maximum employment. The labor market's really important for the Fed. The other job is inflation. And so, because inflation has been on the way down, that's opened the door for the Federal Reserve to begin lowering interest rates. Everything to the left-hand side of that red line are interest rate changes, cuts that the Fed has already taken, starting in the fall of last year, where the Fed said, you know, inflation has come down a long way. It might not be all the way back to where we would like to see it, but we've made progress in a direction that would allow us to cut interest rates. To the right-hand side of that red line is future expectations. That's not my crystal ball. That's the aggregate expectation of the market, the Fed funds futures market. Right now, the futures market is anticipating, if you read across the right-hand side of this graph, that the Fed will cut interest rates by another 100 basis points, so 4 cuts of 25 basis points each, over the next year. That would bring the interest rate, that would bring Fed funds rate down to about 3.25%. That, again, that would have influence on the way, the rates at which we borrow money and the rates at which we can lend money as well. It's the other part of this equation that I think has become really interesting, because yes, inflation has come down a long way, but is there a possibility that tariffs, again, if the rhetoric becomes reality, will tariffs have an upward pressure on inflation? Economists actually debate this, whether or not tariffs are inflationary. If you listen carefully, the debate's actually about the definition of the word inflation. It's not about tariffs. Because a strict economist sitting in a university somewhere will say, well, inflation actually is a sustained rise in the price level. Tariffs are not a sustained rise in a price level. They look more like a price shock. If there's a 20% tariff applied to something, the price of that thing goes up by something around 20%, maybe not exactly. But it doesn't keep going up another 20%. So an academic economist will say, well, that's not really inflation. Tariffs aren't really inflationary. The real world kind of thinks differently. So there's another survey that's done that asks consumers, what do you expect inflation will be a year from now? Again, not my crystal ball, but the aggregate outcome of a survey. And over the past several months, it's not a new term development, consumer surveys are expecting inflation by this time next year to be something over 6%. This is going to make the Fed's job very challenging because, again, the Fed has to walk that tightrope between economic activity and pricing pressure. How the Fed navigates that potential conflict in their job description is probably the single most important thing going forward, not only for the economy, but for financial markets as well. A certain thing to watch. I'm rounding third base towards home now to financial markets. All of this uncertainty and unpredictability economically has translated into market volatility. That's another one of those observations. There have been multiple sessions during the month of April in which the market's been down 2, 3, 4, or 5%. But there have been also multiple sessions in which the market's up 2 or 3 or 4%. That's volatility both on the upside and the downside. There are a number of ways to measure that. Quantitatively, the way in which an investor measures it is through the VIX index, which is what you see here. Shorthand is it's the fear index. It is technically the aggregate total of all the implied option volatility for every equity option trading on the Chicago Board of Exchange. That will not be on the test. You don't have to remember that. But you can see these spikes in volatility, often, not always, often they're associated with some sort of development. The pandemic, the global financial crisis, the US rating downgrade, obviously. I show you this just to say this is a big one. Where it is now, that's the third highest mark on this page, next to the global financial crisis, next to the pandemic. If it feels like a lot of volatility in the markets, guess what? It's a lot of volatility in the markets. I think, however, there are two really broad silver linings here. And as an investor, I take a lot of comfort from this. The first of which is market leadership has really broadened out. Last year, we talked about the Magnificent Seven, these large cap technology companies that were pulling the market higher just because they were such large weights in the index. It was true in 2023 as well. That is not true anymore. This is a graph that captures every single one of the 500 stocks in the S&P 500. There are 500 bars on that page. Trust me, don't count them. Trust me on that. This is as of last Friday. That's the S&P in the red line there. So year to date, the S&P is down, it's volatile, I have to actually check the number, down about 6%. So everything to the left of that line is outperforming. Over half the market, by name, not by weight, is outperforming. That's actually a lot broader participation than has been the case for the last 2 or 3 years. As an investor, as an active investor, I take comfort in that. Last year, whether you outperformed or underperformed the market was all about did you or did you not own NVIDIA? And if the answer was no, I didn't, it was almost mathematically impossible to outperform. That's different now. That's healthy for the market this time around. The further comfort I take, if you look to the very left-hand side of this, that over a third of the market, 36% of the names, are up year to date. So this hand-wringing about the bear, are we in a bear market, are we in a correction? 36%, 179 of the 500 stocks in the S&P are up. There's almost like there's this stealth bull market underway, even though on the right-hand side of this, a lot of those large cap technology companies have proportionally dragged the market down. There's another silver lining, and I'm going to go back to this chart of volatility. What really interests me as an investor is not that every once in a while prices become volatile. That's a feature of markets. It's not a bug. It's not going away. Sorry to be the bearer of bad news. You've signed up for this if you are investing in public equities. What's interesting to me is what happens next. I'm allocating capital on a looking forward basis. And so just to do the analysis, I've gone back and cut a line at 35. What happens after the VIX tops 35? Nothing magic about 35. Other than it doesn't happen that often. It's happened 16 times in my career. And these are those 16 times. Well, now 16 times in my career. So I can fit the analysis on one page. The analysis is pretty simple. That first column of dates or periods of volatility spikes, some of those dates you will recognize. 9/11 is in there, the global financial crisis. But again, some of them you may not remember. The second to last one here, August 5th of 2024. Does everyone remember the great bear market of August 2024? It was August. People were trying to take a vacation. Market went into a tailspin for like 3 days. The market was down about 15% in 3 days. No one remembers that. There were reasons behind that one, but they were very obscure. This one, there's a little bit more rationality to it. What interests me is what happens 1, 3, 6, and 12 months later, after the volatility spike. 1 month later, the market is still fibrillating. The market's up half the time, it's down half the time. You really can't tell. But the further out you get, look all the way to the final column, 11 out of 14 historical times, the market's up a year later, and usually up quite substantially. Reversion to the mean is really, really powerful. Markets oversell on the downside, they overrise on the upside, but after a period of volatility, trying to time the market and say there's more volatility to come, or trying to time the market on the way in is really, really dangerous to your wealth. I shared this with a client some time ago, and he challenged me, and he said, well, I'm better at market timing because I wouldn't be dumb and miss the really good days. I would miss the bad days only. We had a good laugh at that because, of course, no one can do that. But it got me thinking, what if you didn't miss the bad days? As a matter of fact, what if your market timing were so bad that you actually bought exactly when you shouldn't? What if, for example, you had put all your money into the S&P 500 index the day before the World Health Organization declared a pandemic? That's pretty bad timing. What would have happened to that portfolio? Well, that's an historical observation. We can measure it. $100 in the S&P 500 on the 19th of February, you would have been underwater for 129 days. But since then, you would have compounded at just a tad shy of 10% for a cumulative return of 63% in spite of awful, awful timing. What if you'd put all your money in the market the day before Lehman Brothers declared bankruptcy? You top-ticked the global financial crisis. Don't put that on your resume. Or maybe you were underwater for 409 days. That was pretty painful. But over that whole time period, you've compounded at 9.7% compound annual growth rate for a cumulative return of 363%. One more, and then the point will be clear. September 10th, 2001. The markets didn't even open for 4 days after 9/11. And yet over that close to 24-year period, which is hard to believe, 7.1% annualized return, you've doubled your money, and then you've doubled it again. 406% cumulative return. And oh, by the way, that is a time frame that includes, of course, the entirety of the global financial crisis, the entirety of the pandemic, and whatever it is we're going through now. So I've been asked at multiple points by clients of Brown Brothers Harriman over the past month, is this a good time to invest? Should I be putting money in this market? And I always answer the question by saying the real answer to that question relates to you, not to the market. Because if you are a long enough term investor, the answer is yes, this is a good time to invest. If you're a day trader, if you're investing for the next 3 months or 6 months, I can't help you. I got no answers for you. No one has any answers for you. But over the long run, it's not timing the market that matters. It's the time in the market that matters. Market volatility is depressing, it's disrupting, it's distracting, it's discouraging. It is not your enemy. I think of all the investment strategies in the world, the best ones boil down to the basic idea of exploiting the difference between price and value. If you offer to sell me this much value at this price, I kind of don't even care what the asset is, a stock, a bond, a piece of real estate, a company. If there's a gap that I can exploit as a patient investor, that's a good day. The more volatility there is in the price function, the more opportunities that I have to actually exploit that investment strategy. It's not pleasant when it's happening. It reminds me of that old adage, you've all heard it, the secret of success in investing, buy low and sell high, right? What they don't tell you is that if you're doing it right, neither of those activities should feel comfortable. It does not feel comfortable to buy low. Things are going down and down and down, and you want to be the fool that steps in to buy that? Things are going up, they're skyrocketing. Do you want to sell out and have to meet your brother-in-law at Thanksgiving who didn't sell out and hear him all day long? I get it, it's tough. This is where the discipline, this is where the patience, this is where the temperament really, really becomes important. One final page, and then we'll open it for a few questions. The uncertainty is not going away. Even if the White House tomorrow were to declare victory and say, all the tariffs are off, we've struck the trade deals, it's all good, there are other sources of uncertainty. Some of them are known. The debate, the discussion about the tax package, the necessity of raising the debt ceiling. We've all seen the debt ceiling become a football in the past. It will so again. The uncertainty's not going away. Watch the Fed. That's the interesting thing to me, is how the Fed walks that line. And I am listening very carefully. The real data set that's important to me right now in the moment is this last data set. How are companies dealing with this uncertainty? How are they thinking about those potential supply chain disruptions? How are they thinking about pricing? How are they going to be able to protect their margins? How do you make decisions in an environment like this? I will close with just one comment, which is a comment that I basically already made. The uncertainty and the unpredictability for talented allocators of capital, whether you're allocating capital in an operating business or you're allocating capital in a financial portfolio, you buckle up, trust your discipline, trust your experience, and you make the allocation. That's the stuff of investment success, again, whether in a corporate or in a financial setting. And with that, I will bring my comments to an end with hopefully time for a question or two before I release you back and out into the stormy economy and weather. There are umbrellas in your bags, Jeff tells me, but they are only good for the weather. They're not necessarily good for the economy. So, but before we break and part company and I have Cami make closing comments, any questions for me on anything that I have said or anything that I have not said? You may just have to shout out if I cannot see where you are.
Can you speak to real estate, particularly the amount of real estate held by boomer generation?
So the question is about residential real estate, the amount of real estate held by the boomer generation, and implicit in that question is a potential oversupply of real estate?
Yes.
Is that fair? Okay. So in a vacuum, yes. If you just look at the demographics and you look at home ownership, yes, there's no question that as an older generation, maybe ageist, but as an older generation gets to a point in which they decide to downsize, either because they don't need the room or because their house is a valuable store of wealth, there will be more real estate coming onto the market. That's the bad news. The good news is we have a real supply-demand imbalance in residential real estate. New home construction right now is about half the pace that it was 20 years ago. Now, 20 years ago was the global financial crisis. There was a reason for that. But there's not enough supply on the market. So that new supply coming on as baby boomers make decisions to downside will actually in some ways probably help to alleviate some of that problem. What I'm more interested in watching, and I don't quite know how to analyze this quite yet, is younger generations, whatever we're up to now, millennials, Ys and Zs, and I can't keep track of all of it, home formation, home ownership is taking place at a later and later stage in life. And part of that's because people are more mobile, and part of that's because, again, one of the lessons of the global financial crisis was that home ownership is not necessarily the path to financial stability. I learned that growing up. My parents said to me, the sooner you can buy a home, start building equity, that's the path to financial stability. The global financial crisis taught a whole generation of people that may not necessarily be the case. So as we see younger generations rent for longer and delay actual home ownership, watching how that supply-demand imbalance plays out will be really interesting. But it's not just the baby boomers, it's a combination of the baby boomers, which is the supply, along with the demand from younger generations coming up. All right, Cami's given me the hook. Let me just say again, thank you for coming today, and thank you, Jeff and Angela in Capital Chart Room, for your friendship with Brown Brothers Harriman. Cami, lead us out.